Hello, everyone. How are you?
Hello.
We got like everyone was just kind of watching me work for a second. This is how my life goes. So, today we have our very special guests, Miss Emily and Mr. Jake. I've now stopped trying to say her last name because I always botch it up and she never corrects me. So I take it that happens quite a bit for her, right? There's a lot of diphthongs going on in there and several R's. So it's like, okay. Uh, will you say your last name for me once at least?
For the 100th time, it's Murore, but
Lori, for the 100th
yeah,
time?
you always get it right. But then you
Oh,
try to butcher it, but you got it right, and then you butcher it.
oh, well, thank you for being so kind when you say that, I guess.
You
Just
always
trying to
get you
help.
always get A for effort. It's a tongue twister.
Well, that's wonderful, thank you. So today we're talking about cryptocurrency. And but before we get into cryptocurrency, this is our part where we do our stock market update from Emily, where she talks about what she's seen in the market this week and what's going on. So let's take it away, Miss Emily.
Hey guys, how are we doing today? It's Friday. It's hot in Maryland. I don't know if it's hot where you guys are, but it's hot, 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 hot. So again, just like always, I like to kind of give you guys some economic numbers and kind of, share what, we're seeing out there in terms of news and numbers and all that stuff. So I always like to start with the unemployment number, which is the number of new claims that are filed every week. That report comes out every Thursday, as you guys know. It was at 1.3 yesterday. So the number of new unemployment claims were at 1.3 million yesterday. The estimated was 1.25. So it was higher than what was estimated. Last week, we were at 1.3 something, 1.35 or whatever. So it's kind of dropped a little bit, but again, we're still in that million plus range. The total number of people unemployed, I think the last number I saw was 32 million. So, we're still seeing that, like, it's people are still unemployed. Like it's like nothing is like, like, oh, we're seeing a recovery coming anytime soon in terms of employment numbers. What we're seeing more and more of is more companies laying off people, continuing to furlough people. So the people that are furloughed, the people that were, gig workers, they're not part of those, unemployment numbers. So that's something to consider, that the number is obviously slightly higher than what's being reported. But again, nothing new that we haven't talked about in the last, 2 or 3 months. So that's the unemployment number. Obviously, we're seeing a resurgence in the corona, virus cases going up in different states. Different, governments are treating that, differently than others. We're seeing some places, shut down again. I know in Maryland, like the governor is really, really like, strict in terms of restaurants that are reopening or have reopened, that they make sure that they are maintaining that, the social distancing. And there are a lot of, restaurants that are being fined and shut down and licenses being revoked, for not following those, those strict guidelines. So, we're seeing different areas treating the resurgence a little bit differently than others, but overall the cases are going up. Companies are laying off people, companies are furloughing people still. So those, those are being dealt on a company base. So it's not like anything like you're seeing in the news, like, oh, this and that is happening. But we are heavy into earnings season. And I don't know if you guys remember this, but last earnings season, we were talking about how, we were expecting bad numbers to begin with. So, most companies for that first quarter earnings season almost got, it was priced in, they almost got like a free pass, like, yeah, we already know the numbers are gonna be bad. So the market really didn't punish them the way investors typically do. Like, investors typically, like, if you don't have good earnings, they sell, right? This quarter, we're starting to see, the market reacting to companies' earnings, right? So last quarter, where it was like, okay, we know the earnings are bad, they would take away guidance and all that stuff, and you would still see the company price stock go up. This time, we're not seeing that, right? So we're seeing, people actually selling the news. Like, if you don't meet your estimated numbers, we're starting to see a little bit of, investors reacting to that type of news. So that's what's kind of going on in terms of that. We also are seeing a shift. So if you guys remember, when the numbers were spiking, right? When the numbers kept spiking and spiking and spiking, we kept seeing money flowing to like what we were calling their stay-at-home stocks, right? So you were seeing Zoom, companies like Zoom go up, and Amazon, and all these other different at-home or stay-at-home companies. Well, now with this new resurgent, we're not seeing that spike again. Money is kind of starting to shift to where it should have really been during the pandemic, which is those growth companies, like those growth places, like your utilities, your real estate, your basic materials, healthcare, and that kind of stuff. So we're starting to see that shift starting to slowly happen. So we're not getting the same reaction to the news as we were getting before, if that makes sense. So it's just something to keep an eye on in terms of that. But the market has overall still been going up. It's kind of like sitting just kind of sideways the last week or so. No like big, huge movements to either side. It's just kind of like slowing down almost. Almost like the investors are just now starting to pay attention to what's happening in terms of the virus, and just kind of like, it's like almost like a wait and see to what the government's going to do, what the Fed's going to continue to do. But as long as the Fed keeps pumping money into the market, I think we're going to continue to see just the market kind of, inching up and going up as long as we've got money being pumped in. So that's kind of like what I'm seeing this week in terms of that. So, if you are a stockholder, companies are starting to report earnings this week. This week was heavy. We're really going to get heavy next week. So watch out for your company, for the companies that you own in your portfolios for those earnings report. And one of the things that we always talk about is obviously having, portfolio insurance or insurance on your stocks that you own, so that when they do have those bad reports, that you are protected to the downside should they, should the stock take a beating like Netflix did today. So that's all I got for you guys. Netflix took a beating. Yeah, it missed on their numbers, on their subscriptions and guidance, obviously. So the investors did not take that very well. It was down 10% overnight. I think now it's down maybe 4-ish, 6. I think if last time I checked, it's down. It's not down as much, but it really took a hit last night once it reported earnings. But it could be a buying opportunity. Maybe it's just, it's just at a place where now, buyers will come in and step in and buy. It's down 7% right now, but it was down as much as I think 11% last night over the news. But, so just keep an eye out on the things that you own in your portfolios. Keep an eye for those earnings reports, because that could impact your portfolio one way or another.
What's interesting is when we look, there are certain stocks we look at that are economic indicators. So that's what we talk about. It's ironic because as I'm a Republican. In other words, I piss everyone off and I'm fine with that. But there are economic indicators that allow you to see what's really going on, so that what we're hearing from the media, you're able to determine what is real and what is fake news. I hate using that term, but if there is such thing as, something that's been inflated or artificial bias and stuff like that. So you want to know what's going on. Netflix is one of those stocks that we watch because it indicates disposable income. So when Netflix stock is dropping, it's an indication that people are just getting tighter with their funds and they're choosing free forms of entertainment versus even like the $7.99 a month. So that's just interesting to see that even though everyone's home, fewer people have the disposable income to watch Netflix. And that's what I'm seeing. Emily, do you have anything to add to that? Am I right, wrong? Otherwise, tell me.
Well, the way earnings work is that, investors are kind of like looking to cut. It's more like, what have you done for me lately? Netflix obviously has been a juggernaut. And again, we have to look at this in like, big picture wise. Netflix, I think is up 63% year to date. So a 7% drop on earnings is really not that big of a deal when you look at the big picture from where it was at the beginning of the year. Right. So the stock price was sitting at like, I think it was like sitting at like 300 at the beginning of the year. It was at its peak last week, it was sitting at 575. So the drop today, it being down 7% back to 490, again, big picture wise, it's not that big of a deal. But the way investors look at earnings, it's more like, what have you done for me lately? And what's your plan looking forward? So when they don't see the numbers that they were looking for, they just react, they sell the news, right? And eventually the investors will come back in, but they initially just sell they sell them the news of what the earnings is. Netflix was expecting to meet a certain number of subscriptions, and when they didn't meet that number, investors just react to that news. So it's not a matter of people not subscribing or cutting that off. I think if you're comparing it that way, the way you would compare it to is more like, you know, your cable versus your internet stream companies, right? So would you rather pay, you know, whatever you pay $150 for your cable services, or would you rather cut off the cable and pay $7 for Netflix and still get entertained? So if you're looking at it in that sense, then yes, I agree with you where, yeah, consumers are going to cut down on spending and they're going to cut down on the things that they don't need. So if you have a Netflix account, you have a Hulu account, you have Disney Plus, you have Amazon Prime, and you're getting all that entertainment. Maybe you even have, what's the other one that I keep? It's Sling TV, where you do get some kind of live, live streaming from the news cycles or the channels. You may cut off that sports package, especially now there's no sports. Why would you have, you know, your NFL premium or your NBA, whatever, if there are no games? So people will cut those subscriptions down, but they'll keep the less expensive, you know, form of entertainment, because people still need to be entertained. We're home, like we need to have entertainment. So that's more or less, I think, what you were talking about. You're on mute. You're talking to yourself.
Sorry. My opinion is, if you're at home right now and you're bored and need entertainment, start a business. Pick up a book. That's all I'm saying. Dear Lord. Anyway, I've been so damn busy during this time. I don't know how people are bored at home with quarantine. That's just me. Anyhow, so then there's golf. Yes, Carlos, there is golf. So you can watch your ESPN, enjoy your golf shows. I mean, after all, that is the most entertaining sport that we have out there. It's always riveting. And, you know, it's not just for old white men anymore. It can be anyone. Thank you for Tiger and like 2 other guys. Anyway, so enough of that. It's kind of like watching swimming. Actually, swimming is more exciting. And I actually do like golf courses. I live in Boca. So, all right, let's continue. So that's really interesting. So what are we looking for? What do you expect to happen? Like, what do you forecast to be happening? Because we already know that the stock market is acting of its own accord right now. What do you forecast to happen in the next week or so?
Honestly, who knows? You know, at this point, who knows? But you know, the thing that seems to be like the issue is, you know, how to get people back to work, you know, to their daily life and keeping them safe. That seems to be like the battle line, right? And I think as long as people are, you know, doing what they're supposed to be doing when they're out there, you know, social distancing, wearing face masks and all that kind of stuff, I think the market will continue to just do what it's been doing, which is just going up. I think if we have, you know, something different other than that, if the Fed comes in and says that they're not going to do anything further to boost the economy, or the federal government says anything different, then the market could react to that. But I think as long as we have money being injected into the market, and you know, and people, and there, you know, like there's no like major thing that comes out in it. And with companies that are, you know, the biotech companies that are looking for, you know, for the virus, not for the virus, but for the what's what I'm looking for. Not the virus, but the thing that kills the virus. I can't think of it right
the vaccine.
now. The vaccine. There we go. Companies. It started with the V. I couldn't think of it. But yeah, there's a lot of money obviously going into that, and there was news of you know, companies really trying to work on that this week. I can't remember which company it was, but yeah, as long as the future looks better in terms of the virus and it being contained, I think the market will just continue to do what it's doing, although it's way overvalued. I mean, it was overvalued before we got in here, before even the virus started, but that's another story. But you know, as long as that continues, we will see. What I did notice I saw something somewhere, and I wish I'd saved that link. You know, how you tie this back into real estate again, and I think Jake talked about this on Monday. Residential real estate seems to be doing quite fine. Obviously, it's the commercial space that we're seeing. And I think I saw something in an article that, you know, the small business bankruptcies increased, obviously, in July, in June and May. And it's obviously, you know, been happening since the pandemic, but we're starting to see a surge of small businesses obviously filing for bankruptcy. So again, whenever you're looking to invest, make sure that you understand that investing is a risk and know that the companies that you're investing in, you know, may or may not be here in a year from now. So, you know, invest wisely. That's why we always look for good liquid companies, you know, companies that we know, like, and trust, that, you know, but not these, like, you know, you saw an article on some, you know, stream and you just decide to just go buy blindly and have no idea what you're getting yourself into. So
get educated, that's for sure. So that's actually gonna be really exciting. So today we're gonna come back to stock, because this has been our stock sweep week, which has been a lot of fun. We also are gonna have a discussion next week on options, and we're gonna do another one on retirement accounts, or how to use your IRA to actually trade, which is what it's designed for. So, and to speak about that wonderfully is Jake. Is Jake here today? Where is he? I thought I saw him. Hello, Mr. Lamore.
Hey, buddy. How you doing?
How you doing?
I'm doing all right.
Wonderful.
For this good old conversation we're gonna be having about the markets. Yeah.
Oh, it's gonna get good. And the thing I love about so you had to realize that Emily, Jake, and I are kind of like, you know, the three bears and Goldilocks. So you have one that's too hard, one that's too soft, and one that's just right. And the thing is, we can
Who's who?
we just trade identities the entire time. But when it comes to, like, you'll see Emily will never say anything definitive or really give an opinion. But then Jake and I will totally go to town on the Fed and talk about the markets and we're like, no, I got an opinion. I'll share it. You don't have to agree with me, whatever. So Jake, my fellow opinionated, you know, other Jacob, we're going to talk about crypto today. And we're not going to be biased at all. I want to know more about, we want to go ahead and get some basics about, like, what is blockchain technology and how is it changing investing, and we're going to also talk how it affects real estate as it goes. This is going to be a short little intro to crypto, and I'm going to give you guys a link as well to watch a video that actually explains it pretty well. But Jake, what would you like to get us started with on cryptocurrency basics?
Well, I'm actually just curious, real quick, everybody in the chat, who here is participating in crypto? Owner, trader, buyer, holder, hodler, right? Doesn't really matter. Throw your hand in the air, that's cool. Because a lot of people have probably played with it a little bit, right? It's not the same thing it was in 17 when it was super exciting, I would say, and it was new and it's like game changer. Now we're in a phase where I think we're digesting, kind of like after the, I always equated the bubble we had back in 17 to kind of the tech bubble back in the like 90s, because in the tech bubble, all of these random.com stocks went up very high in value without anybody knowing what the internet was, right? You didn't necessarily need to be an expert on, oh yeah, I understand that totally. But if you had anything.com, suddenly it was quite a valuable stock and everybody was buying like crazy. And then the bubble burst, and then we were starting to ask ourselves, well, what is the internet? How are we going to use the internet? What does it turn into? What does it look like? And now we're doing Zoom calls over the internet, right? You can order your food online on DoorDash through your phone. Like, the amount of things that it's turned into and evolved into is far more than we could have ever imagined back then, right? But what it did in the big hype was solidify the idea to stay. The idea of the internet got solidified in mainstream consciousness because there was a spotlight put on value and people paid attention to that. I think the same thing has happened in crypto, and we're in this phase now that crypto, or blockchain rather, I'd say the underlying technology is kind of here to stay. The idea of digital money has always been there, right? But the idea of this kind of type of network has now become a public thing, and we're all kind of figuring out how to really work with that moving forward. And it's really, I was talking with you earlier, Jacob, I really think it's a battle of intellectuals, because a lot of people, very, very smart people, are all trying to come up with more creative ways than the next guy to get to the same answer. And they just think they've done it a little bit better than the next person, which is cool. But I do want to kind of provide some history and talk about it. Cryptocurrency is exciting, and it's something that people have been talking about and planning to try and create all the way back to the 70s. Right? If you think about what the internet did, the internet is a super highway of information. Everything travels. Like, we are now traveling video feed, audio, everything. Like, I have another screen right here and I'm watching the markets, right? So I get real life price action. There's everything's at your fingertips. Like, so much is flowing But there was always a problem, and there was one thing that couldn't flow, and that was value. The exchange of value, the direct exchange. I want to give you $1, right? The internet couldn't figure out how to do that. It could do most other things, just not that. So very, very smart people all the way back in the 70s, there was a small kind of group of individuals, intellectuals, cryptographers, referred to each other as the cypherpunks, started kind of playing around and toying with this idea. They came up with all these different type of, I would say, predecessors to what eventually became Bitcoin. And then in 2008, 9, October 31st, an anonymous person kind of put the blueprint or the roadmap, if you will, for what the major kind of stakeholder in this space is, which is Bitcoin. Most people are familiar with, and most people are, I'd say, comfortable with that concept. And if you go back and read it, I recommend you do. It's really important to understand what I think. There's a big, I think, divergence happening right now between the original idea, what was trying to be created with cryptocurrency, and eventually what it'll be used by. I think those are two very different answers in the long term. But if you read the Bitcoin white paper, it says in there that it was a digital peer-to-peer cash network. That's what we tried to make. That was the idea, which is beautiful. Cash is clean, cash is simple, cash is great, right? You know, if I hand Max a $100 bill, it's done. It's instant settlement, no fees in the middle, right? It's like bing, bada, boom. And we know what happened, right? That was cool, right? Why can't we do that digitally? That's what we tried to make happen, right? Now, how we could finally agree upon, how do we know that when I sent Max $1 that I didn't just digitally replicate these extra dollars? And for those of you that have been in crypto for a long time, you understand the double spending problem. And it was really the big crucial focal point that Bitcoin solved, which was how do you not have these digital dollars constantly replicated and being spent over and over, right? Counterfeiting is a big problem. Even with cash, they're constantly trying to outsmart these counterfeiters, right? It's a really big problem. They have to change the $100 bill, the $20 bill. Like, this is a big thing. So what they said is, why don't we just have complete transparency? Radical transparency is the answer. Let everybody know exactly how much everybody else has in the entire world all at the same time, instantaneously, real-time data. Solves everything. Because we all get updated simultaneously when I send somebody money and you collect it. Everybody in the world gets updated. There's no question about it, you know, and it's kind of hard to change all the computers globally if somebody wants to do this, right? Yes. Now, I would say that's where we started and where we kind of grew from, right? That underlying network is what is referred to as blockchain technology, which most of us are familiar with. And most people are getting on board with that type of infrastructure and network because of its security, right? Nowadays, the question I'm asking myself is, will cryptocurrency really be that digital peer-to-peer cash-like network? Or will we drop that in favor of the underlying technology used as just a ledger system that makes for maybe a little bit faster, more efficient systems within networks, but no longer needs the coins themselves? Who knows, right? I think there's a lot being figured out there. But there was a few things that it did rather well. And one thing that I'm going to be looking at, specifically with some of the more major coins, things like Bitcoin, would be how they perform when, I would say not if, when we see larger amounts of inflation. That to me is the real answer, because they tried to solve the inflation problem through scarcity. The idea of capping the amount of coins in circulation. I'm curious to see how that performs. So we're really gonna see that, because the government decided instead of raising taxes, they were gonna just dwindle our buying power, right? They're using, what is it, 55% of all federal spending is coming through the Fed. Like, it's ridiculous that they're just gonna eat away all your buying power underneath your feet. So while that's happening, a lot of asset prices due to inflation should start to rise. And I'm curious to see how that performs. Now, if it doesn't perform, I think the idea of it as a value store, maybe even as a currency model, might die with it. The network, though, won't. The network is too ingrained. Companies like Ripple, you know, they've created these nice kind of peer-to-peer networks between larger institutions that transact using fiat. They don't use their own coins for those networks, but they use fiat, and that type of stuff will stay. I think, to me, when you're looking at it from an investment perspective or even a trading perspective, it's no different than Forex trading. For those of you that are currency traders, whether you're trading the major pairs, an exotic pair, a cross currency pair, it's no different. The bigger difference to me is you don't get the leverage that you do necessarily with regular Forex trading. It's not as regulated, but you get bigger movements. So for those of you that do trade, treat it like you're Forex trading, right? Run your systems in the same way, your technical analysis, your chart patterns, barring the fact that it's a little bit more manipulated through larger, it's more centralized in ownership, right? So a lot of people own a lot of it, so they can move markets a little more than some of the big fiat currencies. It's hard to push the dollar, it's hard to push the pound type idea, even though it can be done. But treat it from that perspective. But I also think there is a possibility that in a massive inflationary environment, because guys, we haven't had to deal with anything like that, in my opinion, at least not from my investing career and some that I've ever seen. It's been pretty just like the problem was lack of inflation. That's what the Fed's been talking about so much, right? They're like, how do we spark it? How do we increase it? How do we, you know, at least that's what they're saying on the top of the surface. Well, while that's happening, owning some of this is probably a good idea. You know, to give you some hard data, you know, Jacob, you said last time, I think I was on the call, 10% of your portfolio can be in commodities. I think personally, I think that's rather heavy. I think it's a little
physicals.
Okay, I think it's a little heavy. But that's fine. Everybody has their own percentages. I think 3 to 10% is that ideal number. 10%'s heavy, 3%'s light. Find what fits you. And then what I do with coins specifically is I go 85-15. I go 85% hard metal, gold, silver, platinum, palladium, all that kind of stuff. I go 15% digital. Those are going to be your Bitcoins, your Ethereum, your Ripples, your Litecoin, so on and so forth, right? I think it's important to have exposure because it could, guys, I like percentage-wise, I made the most amount of money in 2017 just owning the stuff. It was dope. It was cool. It was just running, and there was structural reasons as to why it happened that way, because you could only buy, you couldn't short. There was a lot of other situations there, but it doesn't mean that can't happen again. I would definitely be a buyer. I'd be an investor. As a trader, I think, and you'll see this, I think that there are better things to trade. Shoot me if you want. You know I probably have somebody watching. They're like the most hardcore crypto trader. They're like, yeah, no, Jake doesn't know what he's talking about. But seriously, guys, like regulated markets with powerful products that provide leverage, like options, like futures, like even the regular currency markets themselves, far more liquid, far more depth to them. You could do all right. Right. So I don't think it always needs to be the Wild West where you try and go make your money. You can make your money in some regulated markets as well.
So that actually is pretty interesting. You said like 15 things that I wanted to talk about, but I couldn't get in.
Sorry.
So, well, no, you're fine. I'm just trying to think. One of them was there are some cryptocurrencies that are based in commodities. One of them is called Trident. Trident is actually based in gold. Pretty much what their model is they have a trust, and all their value is actually based in gold physicals. So the trust will take your money, they'll go buy gold, and they'll keep it inside their vault, good for them. And if you actually buy their crypto, it's backed by that actual commodity, so its purchasing power is preserved in gold. When you decide that you want to sell a commodity using that type of crypto, they'll go and liquidate that gold from your account, aka they're going to buy it off of you, and therefore give you that money equivalencies for you to go conduct your transaction. So there are some other currencies out there that aren't as well known that actually have an ability to counteract the market by holding on to purchasing power through a physical. Now, I actually know the owner of that company, so I might be able to get him on here and talk about it. It's actually really fascinating. I really do think it's interesting. So what questions do you guys have about crypto and blockchain technology? Do you guys have any so far?
I do want to throw one thing out about Trident real quick, and then we obviously field as many questions as you can. if you're gonna own gold, for me, I always want to own a physical because it's more of it's a hedge. Like even with GLD, like there's a lot of other ETFs or other trusts type of oh, that makes me laugh. Don't get into Dogecoin. Don't do it. No. So that was a private message. Don't
Do it. Do it. Do it.
if everybody's saying jump off the bridge, don't do it, right? No, when you own the commodities, my viewpoint on them is like if I buy gold, like I lose money on the transaction. Technically speaking, I'm gonna have storage costs. I have a premium I pay over spot. On exit, I usually price my exit at 70 to 85 cents on the dollar mentally. Like I don't even think I'll be able to get real value if I ever needed to sell it. I never think of it as a way to make money. It's more of an inflation hedge. It's the idea to hedge against my cash position. I don't like when somebody else has that. I'm a little weird, but I want to have control, even if I pick the vault or I pick the place that I store it. And I view these a little bit differently. But that's my 2 cents on that. I like what they're doing, and I know who's a part of Trident, and it's cool and all. But just because they make it fancier and more cool, like I don't know. I like to pet my gold bars personally.
That's why I have my gold bars as well. But because I know gold, I don't mind using a cryptocurrency that's backed by gold because it's something I'm more familiar with. That's just, again, your investing portfolio is going to be your own creation that your skill set should do. And what I love about both Warren Buffett and Robert Kiyosaki both said is invest in what you know. Put all your eggs in one basket and watch that basket. Completely opposite what we hear from our parents and our friends and families. Don't put your eggs in one basket. No. These rich-ass individuals are saying, put all your eggs in one basket and watch that basket. I think that's real set. That was a Warren Buffett quote. Do you have anything you want to say about that, Emily and Jake?
I'm answering these private messages. I would say I heard part of what you said. And in
Or
Robert Kiyosaki's books, he talks, yes, invest in what you know, but also don't bury your head in the sand and don't learn about stuff. I think there's something to be said there, right? So like in 2017 when Bitcoin was hot, buy some. Don't do it with a lot of money, but like take a 2% stake. Take a 1% portfolio stake. You got $100,000. What's $1,000 to you, right? It might pop and turn into 10. So, and I mean, even Robert Kiyosaki talks about that. Like one of his first properties, the way he purchased it is he stacked money in silver coins, maybe bars as well, and then flipped out of that asset into the next. And he was able to use as the down payment into his real estate property. He's also talked about buying small caps, which are kind of smaller growth-based companies, and using those profits that exploded to be able to finance other asset purchases. So I do think there's something to be said for kind of stick with what you know, but people like Warren Buffett who know certain things, like he really likes kind of certain business models, and some of them are really kicking for him, right? Like his insurance business is one of the best out there. We're running at a positive float when most can't. But on the flip side, companies like Coca-Cola have massively underperformed in recent times compared to the tech, and he's always been a little bit off of tech, right? So I think it's invest in what you know, but also have an open mind. Because like I didn't know about real estate till I learned about it. Should that mean I don't invest in real estate? I don't think so. I don't think that's the answer. I think learn about it, make it part of what you know, and then add slowly to what you do. Learn one thing
So
first.
before we keep going,
add.
so what we mean by that is invest in what you know, meaning become a specialist in one area so you understand what you're doing. The language of money is in every asset class, whether it's stock, commodities, real estate, gold, silver, crypto, it doesn't matter. The language of money is there, but you have to learn how to speak that language, and each one of those languages has their own accent. So that's okay, you'll understand what's going on. But because they are the same language and you have different dialects, you're actually able to speak in the rest of them. So like Robert Kiyosaki talks about, he talks about how he missed out on the first wave of crypto, then he looked into it later. He actually then became a big fan of blockchain technology and is now endorsing a cryptocurrency himself that he puts in the Rich Dad Education platform. Now, in that same vein, he does not say that he's an expert in it. He has his team of experts. So that's why I'm saying, watch your basket. It doesn't mean you can't have other people around you with other baskets as well and trade eggs. So that's where I'm going with that. So does anybody in the room, are you guys currently investing in any crypto? Anyone? No, Liz is shaking her head, Jack's shaking his head. No, no, no. Max is very still. I thought Max was going to say something. Max, what are you investing in currently?
Sorry, I hit the unmute button there. I mean,
Yes,
my
please check
normal
out
stock is on TD, but sometimes like I'll put $100 into like Bitcoin fake contracts on Robinhood, even though I know it's not anything real. But you know, I'll make $1 or $2 every once in a while, and it's I only put in $100, and I get a couple dollars out of it once in a while. I'll take that. So yeah, there's slippage, but
What do you like about trading in them?
trading what?
What do you like about crypto that you're buying on Robinhood? Like, why is it intriguing to you?
I can usually sell it really quickly. Um,
So the liquidity and the speed.
Max is a trader. I mean, give him a Snickers bar, he'll trade it if it's a moving price, I feel like, right? So just because it's a Bitcoin contract, I mean, it's movable, but I love how he's using the regulated markets, because you're not going to have so much slippage or so much exit cost typically as much as the Wild West. That was a big problem back in the day. You'd pay like 5% entry and exit, which was ridiculous. But when you doubled every day, you didn't care.
It's very true, because we actually knew a lot of real estate investors. We knew, well, all of us knew of at least one in particular who was doing great in real estate, and then he bought a couple things of Bitcoin and put everything he had into Bitcoin, everything, and then everything went down, and he realized why it was important to hedge a volatile stock or a fad with an actual physical asset that had a proven track record that he knew about. So it was something we're all gonna make those mistakes. We're all gonna get somewhere. We're all gonna have those learning curves. But I thought that was a very interesting one. I'm glad someone else made that I don't have to. Oh, just what I'm saying. So what are some of the, Emily and Jake, what are some of the trades that have taught you the most about what your skill level is and what not to do?
It always goes back to the same thing we always talk about. It's always about education, and you're going to make mistakes. The first thing that we always talk about is not over leveraging. You just mentioned that, right? You can't take everything that you have and put it into just one thing. No matter how much experience you have, no matter, you know, how much you think, you can recharge, anything like that. You just can't do that. We've seen, I think it was last year, where this hedge fund got blown, like literally got blown out, filed for bankruptcy, because they had their whole entire account on natural gas, right? So no matter how experienced you think you are, you just can't take that kind of risk. You have to, diversify in a sense of just don't have everything into one particular thing, right? As you're getting educated, yes, you can small size and bite size your way into things, but just take it easy. The markets are going to be here. Investing is always going to be here. There's no rush to just get into to just make money just for the sake of it, right? Know what you're doing, understand what you're doing, ask questions, be in places like this where you can also reach out and get help and ask questions and get support. So that's what's kept me trading and investing in, even till today, because I can go to people like Jake and we can, talk each other out of certain situations. Like, I want to do this and I want to do that. And be like, well, does it really make sense for you to do this? So, that's to me, it's the key.
Yeah.
So what are some examples of some of the trades you learned early on? Because we all make mistakes, and we typically learn by paper trading first, because it's much safer. It's play money, it's monopoly, it's not real. But what were some of the things that you've either learned? Because you guys have both made incredible trades, and then I'm sure there are equally many that did not pan out the way you had gone.
Those are more fun to talk about. Can I just say, like, if you get a bunch of traders in a room together, most people don't say, oh, look, I made $100,000. No, they want to talk about the war stories if they got their butt slapped to them 10 times over. And I mean, that's usually what happens, unless you guys are sitting in different rooms. But I have a bunch of those stories. You know, I'll never forget right when Bitcoin started to fall and it had its first clip. It was like going from like 20,000 down to like 18, 15 or so. And it started running down. I learned that I thought I was ready for the emotional roller coaster of how much risk I had on the table, but I learned pretty quickly I wasn't. So I think that that's something that as traders, you have to learn pretty quickly. And when I used to teach classes, I always say that there's a difference between the math and the feelings, specifically when it comes to risk, because your portfolio, imagine this, imagine if you have $1 million portfolio invested in and allocated in the stock market. Well, concepts like the risk of ruin theory would state that you're totally capable of risking $40,000 a trade and the math works out and you're golden. But you might have a heart attack if you lose $40,000 on one trade, right? You as a human being might not be able to handle that, have that kind of capability. And there's almost like a self-discovery process where you have to go through and you're like, no, that's not for me. And I remember one day I checked in the morning and I was looking at my crypto portfolio. I put it down, check later in the day, and it was like maybe 4 hours later and I lost like $6,000. And back in 2017, for me, that was like still meaningful amounts of money. I was like, oh shit, okay, that's a little too much. Now, I didn't have that type of reaction when it ran for me, right? So you got to realize when it was all fine and dandy and it went up $10,000 in a day, I didn't think twice. I just thought that was normal. This is how investing works, right? You know, and you're all excited and you're all like flying high. And then it goes against you. And I realized, whoa, okay, deep breath. Maybe I want to rotate a little bit out of crypto and buy some other things, right? And you learn like a personal moment that maybe the math is still fine. And you said, yeah, technically I'm allowed to risk that much. I just don't necessarily want to risk that much. And that's totally cool. It's a personal thing you figure out.
Yes, it definitely is like a learning curve and a personal thing, which is hysterical that you went that way. Now, also something I want to mention is, Jake, when you started trading, you were doing it off of credit spreads by using credit cards that were liquidated or a personal loan,
Yeah.
and then you were investing that and keeping the profits, correct?
Yeah.
And so how much was that loan?
It was 24,000 was the actual loan. I had 1,000 left over that I could throw in, so I started with 25, but 24 was leverage.
And how long did it take you to actually pay off that $24,000 loan?
I kept it for, I think most of the second year I kept it. I didn't need to at that point, but I mean, as long as I was still spreading it, I was okay with that. And one thing you'll find, like I have a personal rule nowadays, I don't want to have less than 30 in an account. Like to me, that's probably a bare minimum just to run a day-to-day trading type business. Because if you're rotating and you're being able to pull out consistently a 5% monthly return, or you're even a 10% monthly return, at those types of levels, you're no longer talking about just hundreds of dollars. You're talking thousands of dollars. Hey, I'm pulling out 2 to 3 G's this month. Hey, I'm pulling out 4 to 5K. Maybe it's not life-changing money like you're going to go on a trip every single month that you wouldn't have done. But to me, it's way more meaningful. So, I mean, technically, if I grew 25 to 30 and I wanted to take that and pay back the 25 and just have 5 to trade, I could do that. But I don't, I mean, one thing you'll find is it's easier to stay consistent and it's easier to take smaller positions, I find, in the stock market when you have more capital.
Mm-hmm.
Right. So instead of you get locked in a box. I'm helping my sister grow some accounts and it's sometimes difficult. It's not impossible, but you know, if you only have $1,000 to trade, Amazon's a $3,000 stock, you know, you're already boxed in what you can even try and buy. And then inside of that, proper position sizing would say you want to only put $100 in a trade, something like that on that type of account size, then you're limiting even more. Right? How much do those stocks even move? Right? What is the earning potential? What can you do? Options will unleash the power of that account. Don't get me wrong. But what I will say, and the value of borrowing money for me was it got me over my fear of borrowing money, because for the longest time I was somebody that was super prideful about having money and not owing money. And I don't know why, it was weird. It was a pride thing. Like I had a ledger. People owed me money. I didn't owe them money. They owed me money. Right. And if my friends needed like $10 or something, they came to me. I ran the books. Like I always had a job when I was growing up. So I always had cash around me, more than the average person my age at that point. So I had to shift mentally to be okay. Because if you're going to be stuck with your own cash, it doesn't matter how much you have. That's a very, very limiting belief set. So for me, it was like I was so uncomfortable in doing it. It was totally against everything I had done. And the only reason I did it was because I had Matt Justice in front of a room. He was my 3-day instructor. And he was telling this story of how he started with $2,000 and grew it to where he was. And he made a quick side comment like, man, I can't even imagine where I'd be if I started with 30. And I'm like, well, if that's the lesson he learned, why don't I just start with 30? Right? Let's just do what he would have done. But I don't have that kind of cash. Then obviously it has to come from somewhere. You got to borrow, right? And most of the people that I know that are extremely wealthy, they have a ton of debt, right? They're like gobs and mountains of debt, and they control mountains of assets with it, right? So I think that to me was the bigger lesson. Just by going through that action, 25 G's. At the time, I maybe made $1,000 a month. That was astronomically large amounts of capital to me. Like it was mind-blowing types of cash, right? But then you get comfortable with that. And then $100,000 doesn't seem so bad, right? I actually started borrowing more, right? So started with 25, and then I don't know, like probably just in the account, I usually have 70 to 90 grand just leverage plus my own cash. I've gotten away from that because now I just run my own monies. But you know, I got over that. And that to me has been the biggest unlocking feature, because now when I go look at property, you're going to have to borrow money, right? You get over yourself. I would have been like, no, I got to be that guy. I got to go buy the $10,000 house, you know, fix it up because that's all I got, you know, totally different mindset.
I agree 100%. I'm actually about to post this on, I've got a poll we're going to do here. Poll. Here we go. Launch poll. So guys, I want you guys to answer this question right here. How do you feel about debt? Are you terrified, conflicted? I have none. I have too much. And what is debt? So clearly, I'm not including Jake and Emily in this poll because we know where you are. But for everybody else in the room, go ahead and fill this out because I want you guys to actually, we want to see where you are because that's going to be a real good discussion. Hopefully we'll do that later on next week. So when I started looking at, it took me 11 years to pay off $12,000 worth of credit card debt. And it was a lot for me because I was a dancer. It took a lot of time to get there. And I did it when I won my title. I got a check, which paid off the balance, which is amazing. It felt so good. And I was all debt free for 1 whole month. And then I found myself sitting in a 3-day basic. And they start telling me about OPM, which sounds wonderful. What the hell is OPM? It's other people's money. I love using other people's money. Now it's great. It's fabulous. I love other people's money. What is other people's money? Well, then they told me it was this. And 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 I've got about 10 more in my bedroom. So I didn't at that point. I only had like 3 credit cards, to be very, very clear. So when they taught about leverage and they taught about using OPM to get going, it was life-changing for me. And at that point, I actually found that I was able to get other people's money, mostly through credit cards at that point in time. And I was able to get other people's money for 0% interest. So then I had to figure out what the hell to do with it at that point because it's not indefinite. And if you don't pay it off before that instruction period's over, you've got to pay all that back interest, which is what they don't tell you. You got to read that fine print. So that was just one thing I thought was interesting. And that was just me. But once you understand the power of leveraging debt responsibly, you're gonna be great. If you had to go and buy an investment property every time and you had to buy it all cash, that means all of your money is locked into brick and mortar and a roof, which by the way can burn down or constantly need to be repaired or doesn't sell quickly. It's nowhere near as liquid as stocks are, right? But I know real estate, so I'm sticking with real estate. If all of your money is in one solid physical asset, you got to find some other way to save to buy another one. versus if you learn how to leverage and use debt. So if you still even do something conventional and you go and you put 20% down on investment property, that means you still have 80% of debt. By the way, that inflation risk is now passed on to the bank for 80%. We don't mind that. We like that. But then I can actually spread that same amount and go and buy multiple properties. That increases my cash flow and unlocks more opportunity to take on more debt, to get more assets, to release more opportunity to take on more debt, to get more assets. See how it works here, people? So you want to learn how to use it responsibly. And one thing I love that Emily said that I am going to bring her on here in a second to talk about is what is your, this is interesting here, over leveraging. What you want to learn is you never want to leverage your basement. So whatever it is that you are comfortable living at, your lifestyle. For example, like what Jake's saying, if you're bringing in, if you need $5,000 a month to live at your current lifestyle, and that covers your living expenses and a little entertainment and, you know, some spending capital, then you're good. You never leverage the assets that are bringing you in that $5,000. That keeps you happy. $5,001 and above, now you can leverage that because it does not affect your basement. But you have to know what those numbers are. They make sense. There's actually a formula for it. Emily, in stock, what is over leveraging in the market?
So over leveraging could be, let's say, you know, you have a trading account. Let's say, for example, Jake, you know, we'll use him as an example. He started with $25,000 to trade, okay? We have rules. So you set rules and you say, okay, of the $25,000, number one, you have to calculate your risk. What am I willing to risk overall? Like what's that pain threshold that I'm going to feel if this account drops 5%, you know, 10%, whatever. So you as the individual have to figure out what that number is for you. It's different for everybody, right? But you as the individual have to figure out what that number is for you. That's number one. You have to manage your risk. Number two is when you're now looking to get into trades, right? With that capital, you can't take all that capital and go buy shares of just one particular company. Even if you know that you're risking, let's say 10% of that capital, you still can't take all that money and put it into just one stock in your account. You have to diversify that account. You can't also be in all tech. You have to say, okay, these are the companies that I want to own. I want to own some companies that are in tech. I want to own some companies that are in energy. I want to own some companies that are in financials, because the way the market works, not everything goes up at the same time. When some things go up, some things go down. So it's being able to have a balanced portfolio where all the capital is even. Like you can't love one stock more than you love the other, right? So whenever we look at your portfolio, you're saying, okay, I'm taking, 5% of my income and I'm allocating it towards this different, these different stocks. Or I'm taking I have 20 grand, I'm going to take 5 grand and allocate it to different stocks. Sometimes we just leave money on cash because, again, you also don't even want to have all your money in a trade, because you need to have some money set aside if you need to go buy insurance for your portfolio. So there's always, that rule of you want to leave some cash in your portfolio, and then whatever capital you are using up, you can't just go buy one particular stock. You have to diversify that capital. So if you're using 20 grand to trade and you want to maybe just have 4 trades on, then that would be 5 grand per trade. If you want to do more than 4 trades on, then you would take that money and divide it evenly, and that tells you how many shares per to add to your portfolio. So you can't say, oh, I'm going to have 100 shares of Apple and 100 shares of Verizon and think that you're equal. You're not. Right? Apple's trading at $357 and Verizon is trading at $50-something. So just having 100 shares of something doesn't mean that they're all equal, because they're not priced the same way. Verizon can go up 20% and Apple can drop 5%, and your account will be the negative because Apple is higher priced than Verizon is. Does that make sense? So it's a matter of understanding, your portfolio, your account, and not over leveraging to, or favoring one stock over another.
That makes sense to me.
Can I add some rules, guys, to so if you want some hard stuff, if somebody's trying to learn how to trade, the way that I like to structure kind of some risk rules is 2% on cash flow strategies is my personal risk limit, 1% on directional and or aggressive trading strategies, and I have an automatic liquidation level at 20% of the highest watermark of the account, meaning if there's ever a time period like Corona or something like that, and you just start losing over and over and over again, and I'm ever down 20%, you go from 100 grand down to 80 grand, hypothetically speaking, I force myself to go all cash. It doesn't matter where the positions are, and take a breather and think and breathe. Right? Because it's really easy when you start going down a spiral to really put yourself in a position where it's hard to bounce back from. Right? At least at 20% down, it's only 25% back to get to where you were before. And that's manageable, quite doable. Right? Like don't put yourself in a position where you're hurting more than you should. And also, just real quick, to bring this back to the conversation of crypto, one of the problems I think crypto people are having with the rest of the world is trying to convince people to use sound money instead of debt. It's like almost like trying to convince people to go back to a gold standard, right? Where you're not going to have just debt-based money the rest of your life when we're addicted to the debt money. I think it's tough. It could maybe happen, but I think it's going to take a lot of advocates.
It's going to take nothing. Emily's on the call. I won't say anything. That'll be our private calls.
My Wi-Fi cut off. I didn't even hear anything you just said. Everybody just kind of froze for 2 seconds.
Oh, perfect. Because I was just like, I won't get involved in that part. It's too late in the call. That would have been a fantastic comment like 20 minutes ago. We would have all like gone to town like sharks with chum. Anyway, just rough. So a couple things I want to explore here. So what I want you to understand, guys, debt, there are 3 types of debt. There's bad debt, which is it takes money out of your pocket, no matter what you do. It's just a drain. It's a liability. There is good debt, which puts money in your pocket. Awesome. We love that. Good debt helps us create net worth. And then there is smart debt, which actually leverages good debt to its maximum, and sometimes bad debt, depending on what you're trying to do. Do you know that some people make a lot of money in foreclosure and bankruptcy? Surprise, you may not know how, but there are people who know how to do that. Just like there are, for example, some investors like to take on assets that lose money for them because the losses will offset what they would have to pay in taxes. So there are different things that you're going to learn as you go. But yes, there are positive things about debt, Pam. There are positive things about debt when you learn how to leverage it. Just like if you learn how to work a circular saw, you can build a cabin. If you don't know what you're doing, you could also lose a hand, right? So you want to learn how to use it. It's just a tool. That's it. Now, keep in mind, if you have too much debt, you will never be able to build your net worth. If you don't know how to use debt, then don't use it until you learn it. But if you don't learn how to use debt, you're never going to build wealth because our current money system is based in debt. That's why you always hear people talk about the national debt. The United States is the wealthiest country in the world, and we are trillions of dollars in debt. So if the governments are doing that, and your currency is issued by your government, why don't you learn how to play the rule that they're playing? Get in the same game, people. Wake up. I actually sent an email earlier today to George Antone of Finance Academy. He wrote a book called The Debt Millionaire. It's fabulous, by the way. And he is one of my mentors. Love him to death. He's going to come on and talk about the financial matrix at one point and how to hack the financial matrix. But the thing is, you're going to learn what debt does, and you're going to learn about hidden taxes like inflation and how you can offset a lot of that through stock and real estate investing. So if you're excited about that, let me see you raise your hand. Hey. Yeah? Everybody else's pictures. So I see Max, Jake, and no one else. So cool. Okay, hi, Carlos. You're just waiting. Oh, Derek's there. Okay, thank you. Nelson's apparently bored and eating. Michael, you love what I do. So Robin's clapping. Okay, and everyone else is just off at lunch. Cool, fine. Hopefully Facebook will say something, but I don't know. Okay, guys, so we're going to go ahead and start wrapping up now. It is 4 o'clock. Emily and Jake, you guys are amazing. I'm so glad you've been here. Have you guys enjoyed the stock week, having a difference, change of pace, learning a little bit more about the markets, financial markets, and a little bit of those asset classes? Yeah? Makes it interesting. Now, we're going to continue down this path. Let me tell you what's coming up next week. What I want to do is I want you guys to get an idea of how to offset some of your risk in real estate by actually using stocks and vice versa. So we are starting our Stock Market Survivor Challenge. Now here's the deal. If you want to go and you want to actually participate in the Stock Market Survivor Challenge, I'm going to put the link in the chat box in a second. Otherwise, once 48 hours has passed and the domains have actually uploaded, you can go to stockmarketsurvivor.com directly. But I'll put the link for the backdoor in the chat box. Nelson, I'm not even looking at you. I can't. I'm done. I heard it. Anyway, there are too many gay guys on this call. Sorry, it's awful. Moving on. So you're going to get the code. You'll be able to go to stockmarketsurvivor.com and actually apply. Yes, there's an application process to work with Emily and her team. We are then going to use that time to teach you the basics of trading. You're going to learn about stock trading for this little challenge. You're going to learn how to paper trade, how to open up a brokerage account, and how to actually read graphs and charts. Therefore, you'll be able to make educated decisions. Like everything else we do in Investor Party, you have to actually show proficiency before you can move on to the next class, and you cannot take more than one class at a time. We are not a burn and churn education company where you have to go and take a bunch of classes before a contract is up. No. Instead, what we're going to be doing is teaching you guys how to do something and take advantage of opportunities in front of you. Conquer your fears, start small, and grow. If you are currently in Real Estate Survivor and you've not put a deal under contract, you are not allowed to take part in Stock Market Survivor. If you are going to take Stock Market Survivor, which is going to be awesome and incredible, you will not be able to enroll in the next Real Estate Survivor until you've shown proficiency in your Stock Market Survivor. See how that works? The idea is that you actually stay focused and you start building your net worth and you start building your skills one step at a time. You're not going to miss out. There are still going to be houses available after this, and the stock market will still be around when this is all done too. So just pace yourself and get good at something. Now, that's going to be womp womp. Sorry, Bo. So, what we're also going to be doing is we're going to be adding, oh, Jesus Christ. Kids, I'm live. So then what we're going to be doing on top of that is we're going to be adding on an investor party. So I want you guys to go to investorparty.com if you haven't already, like us on Facebook, everything else that goes with it. Go to investorparty.com and watch some of the training videos that we have on there for both real estate and now stock. Emily has been putting up some videos and some blogs. So we're going to be upping that level. Don't be surprised. There is going to be a price tag for Stock Market Survivor. That is going to be announced next week. Right now, we got to figure out who is actually interested to make it worth Emily's time. Emily, in my eyes, you're priceless. You can't put a price on that much brains and beauty. It's just my opinion.
Oh, man.
So we're going to continue with that. Now, next week, let's follow up with what's going on. We got a lot going on. As of Sunday, we are going to be working on a mobile home field training. So for those of you who are on Investor Party, you're going to get exclusive content on what we are doing behind the scenes. Jose Garcia is coming down here, and we're going to be joined by Robin Crawley, potentially Kim Christie. Elise is going to come down as well, maybe even Derek, maximum Derek. And we're going to actually go through and look at mobile homes and teach you guys what to look for, the relationships to build to get them at a discount, the way to actually acquire these properties, flip them, and sell them to investors and keep a spread. There are so many ways we're going to go about doing it. We're doing that this Sunday and Monday. So Monday, our 3 o'clock call is going to be while we are in the field. Now, I might be home with it, but we're going to be talking about what we have done through that weekend so you guys can see what that mobile home field training is like. Then later on in the week, we're going to have more options. We're going to talk about options trading, and we're also going to be talking about how to use your IRA to make sure that you can actually invest and use your IRA like you're supposed to. So makes more sense that way, right, Jake? So, so yeah, it makes sense. So that's what's coming up next week. The following week, we're already planning that as well. We're hoping to have Frank and Sherry Calendario on talking about nonprofit housing. and shared housing strategies. And we're also going to try to get people like Georgia and Tone on here talking about how to use debt effectively, and possibly someone talking about asset protection. So we are now starting to up your game now that you've been on Investor Party long enough to understand that it's legit and we're not going anywhere. Thank you guys so much for being here and being a part of this program. This community is the only reason why we put up with so much, and we make all this worth it. So support each other, reach out to each other, friend each other on Facebook. If you guys have been here and you haven't liked Jake Lamore on Facebook and Emily Murray on Facebook, what are you waiting for? They're fabulous. Get out there and do it. If you haven't started emailing each other, what are you waiting for? Start doing it. And if you have not added investorparty.com to your phone, what the hell? Get on it. So, oh, I might get nothing. So that was fun. Anyway, you guys are wonderful. You're amazing. And I will see you next time on Investor Party. Take care.
Guys.